Hi friends, good evening all of you. So how are you? I hope your day is good. So today we are starting with yet another accounting standard, which is International Accounting Standard 33, earnings per share. A very simple standard, but very important standard. So the importance of this particular standard in real life, you cannot even imagine if you are not into financial analysis. For example, take a company, any company, you call it, Walmart, Flipkart, kind of Amazon, any company you take, Reliance Industries, Microsoft, Google. So normally how the company is valued. So I am just coming out of accounting standard 33 to give you a basic understanding of what is the importance of EPS. So once you understand the importance of EPS, then you can enjoy the subject, you can enjoy this accounting standard. So have you heard something called PE ratio? PE ratio is market price of share, or you can say price of share, or you can say market price of share, or basically it is nothing but price of share. Price of share by earnings per share. So our EPS IAS 33 deals with the denominator, earnings per share. Okay. Now every industry will have one PE ratio. If you open, any application like Money Control, Economic Times, which deals with the national or international finance companies valuation, this kind of stuff. So if you open any application or any website relating to business, they will tell you what is PE ratio belonging to that particular industry. Say for example, this company belongs to banking, and in banking sector, just for the sake of numeric example, imagine PE is 20. In case of banks, imagine PE is 20. Okay, now if the EPS of this particular entity is, say for example, $2. What is the EPS of this particular entity? We are speaking about Exxon Corporation. That Exxon Corporation is into banking business and their EPS is $2. Earnings per share is $2. Okay, now by way of a cross multiplication, can I say earnings per share into PE ratio is price of the share? Mathematically, LHS, RHS. RHS is right hand side is A by B form. It is in A by B form. So by way of cross multiplication, if you send the denominator to the left hand side, PE ratio left hand side into denominator of right hand side is nothing but the numerator of right hand side. So PE ratio into EPS is equal to price of the share. So PE ratio into EPS is equal to price of the share. Now PE ratio, if you apply 20, into EPS if you apply $2, so price should be $40. Correct? Now imagine in New York Stock Exchange, if this particular share is available at $34.8, my dear friend, this particular company's share is underpriced purchase. It can be as strong as 40, but it is underpriced, 34.8. So you have to buy this kind of companies. You understand? So this is one. Second thing is, this is one importance of EPS. Second thing is, have you heard cost of capital? In finance you might have learned cost of capital. So when you calculate cost of capital, the main component of cost of capital is cost of equity, which is KE. The main component of cost of capital is KE. So what is the formula for this KE? Do you remember? KE is equal to EPS by P into 100. Again EPS came. Then if you remember little bit of capital structure theories, the firm will be valued at EBIT into 1 minus tax rate. Sometimes you will take, sometimes you will not take EBIT into 1 minus tax. Either you can put into 1 minus T, or you can skip also based on the assumption whether there is taxation or no taxation, divided by cost of capital KE. So this gives you the value of firm. So whether you value firm based on PE ratio or you value firm based on capitalization of the operating profits, EPS is playing a big role. EPS is playing very big role. You understand? So in real life, this EPS plays a very dominant role in determining investment activities. For example, a mutual fund company is there, or a pension plan is there, or any institutional investors like LIC, like this kind of big companies, they want to invest 10,000 crores, 20,000 crores, $100 billion, $10 billion. Like this, they want to invest big amounts of money. Private equity funds, venture capitalists, they start their analysis with this EPS. EPS plays a very big role. So in classroom, when you are reading IAS 33, you might not be able to understand the real life importance of EPS. For you, it is like, Pavan sir, in 10th class, 11th class, 12th class also I studied, Pavan sir, EPS is equal to net profit attributable to equity shareholders divided by number of shares, Pavan sir. This everybody knows. So even those who have joined first year of BCom also will tell you formula. If you ask, hey, what is the formula for EPS? Net profit to equity shareholders, net profit attributable to equity shareholders divided by number of equity shares. So everybody tells this. Having said that, there are so many important points to be considered while determining the numerator, and very important thing is the denominator. You understand? So the focus of IAS 33 is on the denominator. The focus of IAS 33 is on the denominator. Okay, so we'll start with this IAS 33 earnings per share. IAS 33 earnings per share. So right now, IAS 33 earnings per share. Okay, I'll give you so many examples. I have 3 problems here in this module, but other than this also, we'll be solving so many questions. Okay, so look at the overview. IAS 33 sets out how to calculate both basic EPS and diluted EPS. That means they're speaking about 2 types of EPS. One is basic EPS, one is diluted EPS. Okay, the calculation of basic EPS is based on weighted average number of ordinary shares outstanding during the period, whereas diluted EPS also includes dilutive potential equity shares such as options, convertible instruments, if they meet certain criteria. So in the overview, they are speaking about 2 things. How many types of EPS are there? 2 types of EPS are there. What are they? One is basic EPS, second one is diluted EPS. First we'll speak about basic EPS, we'll learn how to calculate, and then we will go to diluted EPS, and then we'll go to diluted EPS. Okay, so now write down first example, example 1, problem number 1. Okay, under that write down net profit after tax and after preference dividend is 1 lakh US. Net profit after tax and after preference dividend is 1 lakh US, or you call it 100,000 US. Okay, on 1/1/2021, number of ordinary shares outstanding is 10,000. 10,000 ordinary shares are there. Ordinary shares are nothing but equity shares. 10,000 ordinary shares are there. On 31/12/2021, the company issued another 10,000 ordinary shares. Calculate earnings per share. Calculate earnings per share. Okay, so you give it to a student of finance. Who doesn't know this IAS 33? You do not know IAS 33. You know only finance, financial management. You know, in financial management, you learned EPS is equal to net profit attributable to owners, equity shareholders divided by number of equity shares. Net profit attributable to equity shareholders divided by number of equity shares. So he'll calculate it like this. Pavan sir, numerator is 100,000 US dollars divided by denominator is on 31/12/2021. I have old 10,000 shares and I have new 10,000 shares. So total shares I have is 20,000. So divided by, I'll put 20,000 shares here. That gives me $5. What is my EPS? $5. 1 lakh by 20,000. $5. Now you tell me, being the student of accounts, keep finance aside, being the student of accounts, having little bit of understanding of this earnings per share, you tell me, is it the correct answer? How many of you believe this is correct answer? How many of you believe this is wrong answer? So please give your response in the chat box. I want everybody to participate. You participate, you learn. You do not participate, you do not learn. That's it, as simple as that. Everybody is saying wrong. Why it is wrong? Why it is wrong? Hey, some student is saying correct. Dude, seriously? What's wrong with you? This is wrong. Because see, numerator is profits, correct? Denominator is shares. But if you observe, this is your year, okay? 1/1/2021 till 31/12/2021. This is your full year. So profit belongs to this. Profit belongs to this. But number of shares you have taken here. So numerator is for year. Denominator is you have taken at the end of the year. Not matching. So one parameter you are considering this, one parameter you are considering this. How? When you apply a formula, there should be consistency. Numerator year end, denominator year end, correct. Numerator throughout the period, denominator throughout the period, correct. Numerator belongs to full year, denominator belongs to end of the year. What justice this is? This is not mathematically correct, logically correct, and from the point of view of accounting standards also, it is not correct. So, what accounting standard said, you know, don't take number of shares at the end of the year, take veins. Yeah. Sir, veins, is this something to do with Marvel Avengers? No, veins is not Marvel Avengers. Veins, weighted average number of equity shares. Weighted average number of ordinary shares or weighted average number of equity shares. So take weighted average. Pavan sir, what is the meaning of weighted average? Weighted average means apply time proportions. First 10,000 ordinary shares are there for 365 days. Next 10,000 equity shares are there only for 1 day. So weighted average number of equity shares or weighted average number of ordinary shares is 10,000 opening divided by 365 into 365 into 365 divided by 365 plus second 10,000 is only existing for 1 day. So this is 10,000 shares plus that is 10,000 into 1 by 365. Calculators are, where are you? 10,000 divided by 365 is 27.39. So I can round it 27. I can round it off to 27. That means 10,027 shares. Now if you calculate EPS is equal to 100,000 US dollars divided by 10,027 is equal to $9.97. $9.97. So if you take closing, what was the answer? $5. But if you calculate properly, it is as good as $10. So this is correct way of calculation. That is what your accounting standard told. You understand this? Guys, all of you understand? Very good. Copy the answer. Copy the answer in your notebook. We'll continue. Okay. Once you are done with this, now look here. Read this. The calculation of basic EPS is based on weighted average number of ordinary shares outstanding during the period. Oh my God. So actually speaking, 90% of the standard speaks about this only. 90% of the standard speaks about how to calculate weighted average number of shares. You understand? Okay, now write down. Then objective of IAS 33. The objective of IAS 33 is to prescribe principles for determining and presenting earnings per share. Again, no accounting, no recognition, no measurement. You will not learn any journal entry. You will not measure anything, nothing relating to accounting here. It is only disclosure based standard. Only you disclose, you calculate EPS and you present it in financial statements. That's all. On the face of P&L, you write it. That's all. So the objective of IAS 33 is to prescribe principles for determining and presenting EPS. Amounts to improve performance comparison. And different entities in the same reporting period. This is one type of comparison. Different reporting periods for the same entity. This is another comparison. They are speaking about two different things. You tell me what is one, what is two. Okay. Hari, can you tell me, turn on the mic and tell me what is one, what is two?
Different entities in the same reporting period.
What is that?
Is one.
What is that? Meaning.
As in, that means basically if there are two companies, it should be comparable. Basically, it improves comparability as such.
Superb. So what is the second phrase?
Different reporting periods of the same entity. That is comparative statements. That is between different years of the same entity.
Superb.
That is
so any technical term, the jargon, what we use, proper terminology, are you recollecting any point for this? You might have studied this in ratio analysis, you might have studied this in analytical procedures in auditing, you might have studied this in many places. In many accounting standards, this will come.
Comparability and...
yeah, what type of comparability? It is called inter-firm comparison, intra-firm comparison.
Yes.
Inter-firm, intra-firm. Okay. Write down in your notes. So, mute your call and write down in your notes. Objective of IAS 33. Objective of IAS 33. Single point objective. Improve performance comparison. Improve performance comparison. Improve performance comparison. Two types of comparison they are speaking about. What are the two types? Different entities in the same reporting period. Different entities in the same reporting period. Okay. Then the second one is different reporting periods for same entity. Different reporting periods for same entity. Here I will give you example, different entities in the same reporting period. So take financial year 2021. Compare the performance of Here EPS, compare the EPS of Google Incorporation with Microsoft Incorporation. This is 1 year, 2 different entities. Here one entity, Google, you are doing, for Google you are doing 2020 versus 2021. Okay, so this is called intra-firm comparison. This is called, sorry, this is inter-firm comparison. I'm so sorry. This is inter-firm comparison. This is intra. Intra means within. Intra means within. Inter means between. Intra-firm comparison. Inter-school competition, inter-college competition. So many colleges will come. That's all. So the objective is clear. Can we go to next topic? Scope. Do you think every company needs to present their EPS? The answer is no. Normally this will be for listed entities, publicly trading entities will be there. No, normally it is for them. Okay, so IAS 33 applies to entities whose securities are publicly traded, that means listed company, or that are in the process of issuing securities to the public, that means you are listing for IPO or further issue proceeds. Either it can be initial public issue or further public issue. Other entities that choose to present EPS, that means for publicly traded entities it is compulsory. For other entities, Pavan sir, I am not a publicly traded entity, but still I want to present EPS, Pavan sir. Okay, follow this standard, no problem. But if you are outside the applicability of IAS 33, voluntarily you want to, present this EPS, do not present EPS as per your will and wish, whims and fancies. Even voluntarily you want to present EPS also, you shall comply with IAS 33 only. So point number 1, it is applicable to publicly traded entities. Point number 2, other entities, if voluntarily they want to present EPS in their financial statements, you are most welcome. Come to IAS 33, comply with these requirements, publish, no problem. But Pavan sir, voluntarily I will publish as per my will and wish? No. Accounting and financial reporting framework will not accept it. You have to comply with IAS 33. That's all. Otherwise, comparability will be lost. No, one is presenting EPS as per IAS 33. One is presenting EPS, following his own whims and fancies. Then they are not comparable. Now, another question. Pavan sir, what if I am a group entity? I am an entity, which belongs to a group. In that group, there are 20 entities. So I prepare consolidated financial statements and I prepare separate financial statements also. So what to do? If both parent and consolidated financial statements are presented in a single report, if both, here it seems there is a printing mistake, please make a note. If both separate financial statements of parent and consolidated statements are presented in a single report. So here there apparently seems to be a typing mistake. If both SFS, separate financial statements, and CFS, consolidated financial statement, both of them are given in a single report, then EPS should be given only based on consolidated financial statements. That's all. This can be asked as an MCQ. Okay, so what is the rule? If both SFS and CFS are presented in the same report, comply with EPS requirements in consolidated financial statements. That's all. Okay, now they have given some definitions, simple definitions. 1 and 2 are simple. Ordinary share. It is also known as common stock. Globally, we call it common stock. In some countries, they call it equity share. Globally, they call it common stock. In some countries, they call it equity share. So basically, what is that? Equity share, you call it. Ordinary share, you call it. Common share, you call it. Stock, you call it. Common stock, you call it. Ordinary stock, you call it. So an equity instrument that is subordinate to all other classes of equity instruments. There can be more equity instruments. For example, convertible debenture is also equity instrument. Mandatorily convertible debenture, mandatorily convertible preference share is also an equity instrument. But this particular ordinary share is there, no? This is subordinate to all the other types of equity instruments. Answer, what is the meaning of subordinate to? That means in the case of liquidation, your money will come last. First money goes to, you might be knowing that preferential creditors, government dues and all that story you might have heard. So in case of liquidation of the company, first money goes to preferential creditors, like employees, daily wagers, laborer, then government, then secured loans will be there. That secured loans, interest due and principal amount due you need to pay. Then comes to preference shareholders, then comes to equity shareholders. So preference shareholder is also, you can call preference also as equity instrument. Ordinary share also is equity instrument, but who is subordinate to whom? Ordinary share is subordinate to preference share. Preference share will get preferential right in dividends and capital repayment. Ordinary share always subordinate. So after paying everyone, if money is there, you pay equity dividend. After paying everyone, if money is there, you will repay equity shareholders share capital or his part of share capital. But first they cannot claim anything. That is the reason we call them residuary owners or subordinate to all the other types of equity instruments. That means your token will come last. Then what is potential ordinary share? Potential ordinary share means today it is not ordinary share. Potential ordinary share means today it is not ordinary share, but it is an instrument or it is a contract. It is an instrument or it is a contract that may entitle holder to ordinary share in future. Can you give me some examples? Nirmal, can you give one example of potential equity share? Potential ordinary share, can you give examples?
ESOP.
ESOP, very good. Then
Employee stock option.
Very good. Employee stock option. ESOP, correct.
Convertible instruments like convertible preference share debentures and share options warrants.
Exactly, correct. All these things are potential ordinary shares. So potential ordinary shares we use in calculation of diluted EPS. Potential ordinary shares we use in calculation of diluted EPS. Okay, then the major part of the standard basic EPS, is easy to calculate. This diluted EPS, dilution, anti-dilution is there, no? This is very important, very interesting. Now we'll go to 3 and 4. So Hari, can you just read 3 and 4? After that I'll explain. Read point number 3, point number 4.
Sure, sir. Point 3. Dilution. A reduction in earnings per share or an increase in loss per share resulting from the assumption that convertible instruments are converted, that options or warrants are exercised, or that ordinary shares are issued upon the satisfaction of specified conditions.
Okay, continue.
Anti-dilution. An increase in earnings per share or a reduction in loss per share resulting from the assumption that convertible instruments are converted, that options or warrants are exercised, or that ordinary shares are issued upon the satisfaction of specified conditions.
So can you tell me what is the difference between these two? Auntie,
so the first one is EPS is reduced,
okay,
or the loss per share is increased. That means loss is more.
Okay.
Or profits are reduced.
Okay.
And in anti-dilution, the earnings are increased. That is, profit is more. Either way.
Yep. Correct.
In one, loss is increased, and in the other, profit is increased.
Correct. So now look here. This is financial statements for the financial year 2021. So I received this from the company where I invested money. Okay. So what they have given is they have given P&L like this: particulars, 2021, 2020. So they have given revenue, expenses, profit before tax, less tax, profits after tax, less preference dividend, then profit to equity shareholders, blah blah blah, everything they have given, profit from continuing operations, profit from discontinuing operations, all that blah 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 is given. Finally they said tan tadan tadan tan tan EPS. They said $1.2. Here they said $1.8. So they said previous year 2020 $1.2. Then it increased to $1.8. Now I am using my brain, mathematics, finance acumen, calculator, computer, supercomputer, and I called Isaac Newton and asked, sir, last year $1.2, current year $1.8. Could you please calculate the growth and tell me, sir? Could you please calculate the growth and tell me? So growth is calculated like this: current year minus previous year divided by previous year into 100. That is equal to 1.8 minus 1.2 is 0.6 divided by 1.2 percentage. So 50% increase. Oh my God. Now there is one shareholder, Mr. A. So Mr. A calculated it like this: 2020, 2021, 2022, 2023, 2024, 2025. So here this is 1.2, 1.2 is increased to 1.8. Now you started using your brain. 1.8 into plus 50% you did. Then you are getting 2.7 here. Again plus 50%. Oh my God, 4.05 here. Again plus 50%. 6.075 here. Again 50%. 9.1125 here. Oh my God, compounding interest. Growth you calculated like this. Now you asked the CEO of the company or CF of the company. Mr. A is asking CF of the company. Sir, I have invested in 1000 shares of your company. Current year it is 1.8. Sir, after 3 years, 4 years, it will go to $10 na, sir. That guy will get a heart attack. How? You said this is the beautiful calculation, sir. CFO literally will get a panic attack. What the hell you are calculating? How can you estimate 50% every year? Plus, during this 5 years, buyback might happen. Issue of new equity shares might happen. Share consolidation might happen. Share split might happen. Shares conversion into stocks. Stocks conversion into shares. The new issue of instruments which can be potential equity, like convertible bonds I can issue, convertible preference shares I can issue. So many things will happen in this 5 years. So I have given so many options to my employees. ESOP I have given in 2019. That will come, into issue in 2024. So all these things are there in between. Now CFO will say, dear Mr. A, you don't have brain, so please don't use brain. Thank you. If you don't have brain, don't use brain. Okay, now he said, but I want to know what will be EPS in future. Then CFO will say, beta, if you want to know what will be probably what will be the EPS in future, I will tell you. There is one way in which it is to be calculated with an assumption. What is the assumption? That all the options or warrants are exercised. So in 2019, you have given 100,000 options to your board of directors, to your managerial personnel, which will come to issue in 2024 with a service condition that they have to work 5 years. You said, I'll give you 1000 equity shares, 1 lakh equity shares. This 1 lakh equity shares today, 2021, today we are making this class, we are doing this class on 37/2021. Today, what is the shape of this 1 lakh shares? Are they actual shares today? No, they are share options today. Now, because you asked me, Pavan sir, what will be my future EPS? Tell me. So I'm closing my eyes and I'm thinking, okay, in future what will happen? Probably all these 1 lakh, maximum worst case 1 lakh options, 1 lakh equity shares I have to issue. So today I assume that all the options are exercised, so shares will go up by 1 lakh. And all the conversions will happen. Convertible debentures, convertible bonds, convertible loan stock, convertible preference shares. So all these conversions are actually happened. Assume that these happened. So there are another 2 lakh shares will increase. Another 2 lakh shares will increase. And there are contracts. There are contracts. What can be the contract? The contract can be loan with a bank. The contract can be loan with a bank. So on satisfying certain conditions, banker has a right to convert this loan into equity share if at all the condition happens. And if at all the bank exercises the option, another 4 lakh shares you need to issue. So today you have 1 million ordinary shares. But in future, it can go by 1 lakh, it can go by another 2 lakhs, it can go up by another 4 lakhs. So in the worst case, your number of shares will be 10 plus 1 plus 2 plus 4. 17 lakh ordinary shares. So what is this 17 lakhs ordinary share? Go back to the definition with an assumption. What is the assumption? Assumption about 3 things. Convertible instruments are converted. Okay. Options and warrants are exercised. Okay. On satisfaction of conditions, ordinary shares are to be issued. Okay. When that 3 things happen, what would be the impact on my EPS? When you calculate that and give it to shareholder, it is called diluted EPS. So 2021 basic EPS is $2.5. Okay, then what you have done, this is A. B, you made adjustments. Adjustments for what? For these assumptions. You have 3 assumptions, no? 1 plus 2 plus 3. What is 1? All convertible instruments are converted. What is 2? All options are exercised. What is 3? On satisfaction of conditions, you had to issue shares to other party. All these 3. When you give effect to this 3 and when you have calculated EPS, that came to 3 point or that came to $1.72. This is called dilutive because EPS per share decreased. Or in another situation, 2021 your basic EPS is $4 negative. This is called loss per share. It is not EPS, it is LPS, loss per share. When you have given this effect of assumption 1, 2 and 3 and then you calculated, then it came to $5.20. So increase in loss. So if there is decrease in EPS or if there is increase in LPS, it is called dilutive. Now Mr. John Doe will get it out. Sir, why will EPS come down at all? It has to go up, no? But beta, when you calculate EPS as profits by number of shares, originally number of shares 10 lakhs, now it is 17 lakhs, no? So when denominator increases, common sense, left hand side will fall. Khatam, full stop. Isn't it? When the denominator increases, the left hand side will decrease, period. No discussion on that. Now the question is, but Pavan sir, simultaneously can numerator also change? Yes. Sometimes when there is a change here, this also might go up. Now John Doe will get it out. How? Because imagine you have 10 lakh or 1 million convertible bonds. At present, you are paying 4% interest. 4% interest bearing 1 million convertible bonds. Each bond can be, or 100 bonds can be converted into 10 shares, or 10 bonds can be converted into one ordinary share. Okay, so you have to issue 100,000 ordinary shares. You have to issue 100,000 ordinary shares in future. Today, denominator is there, no? I am adding 10 lakhs plus 1 lakh. What is this 1 lakh? If conversion happens, ordinary shares would be 11 lakhs. If conversion happens, ordinary shares would be 11 lakhs. Okay, correct. Now, if you are smart enough, Pavan sir, now imagine my income, my profit is 500,000 US dollars. My denominator is 500,000 US dollars. Okay, but while calculating this profit, interest on this, while calculating profit, interest on this is subtracted. But what is the assumption now? Convertible bonds are converted into ordinary shares. Then Pavan sir, subsequent to that, I don't need to pay this 4% interest because this guy is ordinary shareholder now. He is no more a debt holder. So I will not give interest. So my 500,000 US dollars will increase. Increase by what amount? 1 million convertible bonds. Imagine they are, face value $1 into $1 into 4%. So $40,000 interest you don't need to pay now. Now you are paying $40,000 interest. Why? Bonds are there. Tomorrow, what is the assumption while calculating dilutive EPS? What is the assumption? I am converting this convertible bonds into ordinary share. That means when this assumption holds good, you don't need to pay. Interest to them. So $40,000 saved. Now, if you are really smart, then you get one more doubt. But sir, when I pay interest, it is tax deductible. So if my profit increases by 40,000 US dollars, and if I need to pay 20% profit, I end up paying minus 8,000 tax, no? So my increase in profit cannot be 40,000. My increase in profit can be 40,000, but I need to pay tax 20%. So my increase will be 32,000 only. If you understand these calculations, 50% of standard is over. Now, Pavan sir, summary. So you told so many things because you have knowledge, you can speak anything. But we are people with a big body, small brain. Big body, small brain. Summary, please. What is basic EPS? Is equal to net profit attributable to equity shareholders, or you call it the owners of the parent. If it is a holding company, the owners of the parent, net profit attributable to the owners of the parent divided by weighted average number of ordinary shares. This is basic EPS, correct? Now Pavan sir, what is diluted EPS? Simple. Take this and say this is component A. By take this and this is component B. Same A by B take. But plus or minus, that's all. You will add or subtract certain things. These are called adjusted. I am adjusting interest, I am adjusting tax, I am adjusting number of shares. So we'll make some adjustment here, and that becomes your one kind of estimated EPS. If that is falling, you call it dilutive. But Pavan sir, surprisingly what happened, my current EPS is $4, Pavan sir, but when I have given this adjustment effects, the future EPS seems to be $5.20, Pavan sir. Beta, this is called anti-dilutive. It is not diluting, it is increasing. It is not dilutive, it is increasing. Or Pavan sir, at present my loss is 2.50. My loss is 2.50 per share. In future, it will be 1.15. This is also anti-dilutive. So dilutive means if it is EPS, it will fall. If it is LPS, it will increase. Anti-dilutive means if it is EPS, it will increase. If it is LPS, it will fall. Khatam. Two definitions. You understand? Now I'll give you one small example, okay? One LKG example so that you understand. Some people will ask, sir, I am getting headache. What is this ordinary share? What is this dilutive? What is basic EPS? I am unable to understand anything, sir. Now imagine all our friends, Nirmal, Narsimha, Hari, Omar, all these people, they decided to have a blast party. So they are celebrating something, some event is there, some guy is throwing a party or birthday or something. So they bought, this is the table, here 1 chintu, here 1 chintu, here 1 chintu, and here 1 chintu. So 4 people are sitting there. Okay, 4 people are sitting there. Now, this guy who's throwing party, he bought some dish. Say, for example, he bought one chicken bucket from KFC, which has 12 pieces in it. One chicken bucket he ordered, which has 12 pieces in it, and he ordered 1 liter Pepsi. Good boys will drink Pepsi. Okay, so he ordered Pepsi, 1 liter Pepsi. Okay, now imagine this guy is very cunning guy, chalu guy. Okay, so he took a calculator. All the remaining people, they are, arranging their aprons, sanitize, and they are ready to eat. But this guy took calculator and he is calculating. 12 leg pieces are there, 4 people are there. How many leg pieces I'll get? 3. So this guy, imagining 4 leg pieces. 3, sorry. 12 by 4, no? 12 divided by 4 people, 3 leg pieces. So he is thinking of having 3 leg pieces. Then again, he took calculator. 1000 ml divided by 4 people. 250 ml Pepsi will come for me. Yeah. So this guy is very happy. Then he said, Ray, come, arrange everything, we'll eat. Then bell rang, ting tong. So this guy went and opened the door, and he saw two other common friends came. Ta-da! Two other people came. Now, for courtesy, you have to say, "Hey, come, please sit." So you are laughing, you are smiling outside, but this guy's stomach is burning inside. So these two new people came. No, this is one. And here one more. Now again this guy took a calculator and calculated 12 pieces divided by 6 people are there now. I will get only 2 pieces. 1000 ml divided by 6 people, I will get only 167 ml. My leg piece decreased, my Pepsi decreased. So this guy started shouting. My entitlement decreased, diluted, and I'm sad. Now this guy asked the person who's throwing party. This guy is throwing party, no? So this guy asked, "Hey, who these two shameless people are? I don't want to share my leg piece with them. Who these two people are? I want to know." Then this guy said, "This is convertible debenture. This is a convertible preference share. All these 4 are there, no? They are ordinary shareholders. So today, because he is debenture holder, you are not sharing net profit with them. But tomorrow he will become ordinary shareholder. Then he will come and sit in this table. Then you need to share your 12 leg pieces with him. Then your entitlement comes down. This is called dilutive." Then this guy started hating this guy. "I hate you. I hate you. I hate you." Why? Because you are dilutive. I hate you. Then this guy said, "Surprise." What? Guess what? Then you asked, "What?" "I have bought one more KFC bucket because I know you guys are having party and I don't want to be a spoil sport. Take this 12 leg pieces I bought for you." Then this guy again took calculator. "I love you so much." Then he's like, 12 leg pieces plus another 12 leg pieces. 24 leg pieces divided by 6. I'm getting 4 now. I love you so much. This is called anti-dilutive. So this guy, potential equity shareholder, when he is coming, if he is coming with incremental profits, EPS will increase to the old shareholder. That is called anti-dilutive. So now this guy is saying, "Dear convertible debenture holder, initially I thought you are shameless guy, came to eat my leg piece, but now I realized you are such a nice guy. I love you so much and you are giving more EPS to me. Sorry." This is anti-dilutive nature of a potential share. So what should we understand? This guy is ordinary shareholder. This guy is potential shareholder. He might be equity shareholder tomorrow. This is current net profit. 4 is current shareholders. Current net profit divided by current shareholders is current EPS. Current net profit plus adjusted net profit put together, current shareholders plus future shareholders, is called dilutive EPS. The concept is over. Sir, I don't know whether the concept is understood or no. I am feeling like eating something. Yummy examples you are giving. Please, I will send my Google Pay number. Transfer some $5-10 or at least 1,000 rupees. We'll go and buy one bucket and eat in your name, sir. God will bless your family. Thank you, sir. Guys, you understand this example? So, what is dilution? What is anti-dilution? You understand? Hello? So, can we continue? Okay. So, if you do not have doubts, we'll continue.